Hi, and welcome to Leaders in Lending. I'm your host, Jeff Keltner, and I'm joined today by Matt Gallman, the Enterprise Risk Officer at Drummond Community Bank. Drummond is about a $900 million asset bank, Matt, I believe, in North Central Florida, serving some of the Gainesville area, but substantially many of the rural areas up there as well. Matt came to the bank with a long history in the credit union space, where you were a loan officer, teller, you've kind of done all the jobs, and a few years ago, switched into risk management. And I think interestingly, when you got here to Drummond, the bank is historically mostly commercial oriented, but making a shift into the consumer space. So I'm really looking forward to the conversation today. Thanks so much for agreeing to come on and talk to us.
Absolutely. I'm really excited to be on today. Really enjoyed the podcast, and I really enjoyed talking about bank and fintech partnerships. So I look forward to the discussion.
Should be a great conversation. I wanted to start off, Matt, with your title, Enterprise Risk Officer, because typically I've talked to a lot of risk officers, and they're typically in the why we shouldn't do stuff with fintechs, and you seem to be in the why we should. Talk to me about how you think about the risk function, the enterprise risk function within a bank, and what your role is, and how maybe you approach it a little differently than others in the space.
Yeah, so a lot of times I think that risk management has a negative connotation. A lot of people think that risk managers are there to tell you no, to get you in trouble, to shut things down. But that really shouldn't be the case. Really, risk is just uncertainty, and it's all about how we manage that uncertainty. And so you should be spending an equal amount of time talking about how you can take more risk, but do it safely. That's what I always say is, how can we find a way to say yes to something and do it in a safe and efficient manner? And so that's why someone like me is involved in the fintech space. And if you really think about it, with the way COVID has impacted consumer preferences, if we don't start embracing change and we don't start finding partnerships such as Upstart, we're going to become stale and irrelevant in the minds of our customers. And so to me, that's the ultimate risk, and that's what I work every day to try to prevent and set us up for success in the future.
Yeah, I think that the risk of doing nothing is the one that is often underappreciated, the risk of not changing. And it's great to hear that perspective. I'm curious from a risk angle, you guys chose to get into consumer lending where that historically had not been, as most banks outside of mortgages, not a lot of consumer lending. What were the risks that you saw from the bank's point of view that made that an interesting area to invest in?
So right now we're in an extremely difficult environment. It's a challenge for us to try to meet or grow our earnings with historic low interest rates, insane levels of liquidity in the banking system, and with a bank that's been historically focused on the commercial side, on real estate, we have to find alternative ways to generate revenue. So coming from that consumer lending background, I first looked at consumer lending as a way for us to potentially help us reach those goals, to find alternative asset classes that we weren't really invested in, we weren't doing to a substantial degree. So.
And what do you find is different about the consumer asset class that's appealing to the bank versus the more traditional assets?
So right now, especially in 2020, when we were looking at a long-term horizon for mortgages and things like that, to book and retain long-term fixed-rate assets and incur the substantial duration risk is hard for someone on the risk side to stomach. So what's really appealing about commercial loan assets is the short weighted average life of those assets, and obviously higher returns. So it's just an asset class that was appealing to a lot of banks, and I think during the pandemic, a lot of banks were hoping that they were more invested in those asset classes. So.
Wishing they had been, I suppose, as well. So you actually did kind of enter the space during the pandemic, which is, I guess, a little bit unusual to me. I'd love to hear the thought process and kind of how you first got into the space. I certainly know many even of the banks that were originating consumer loans took a hiatus, or at least substantially tightened their policies during the crisis, at least in the early days. And you guys kind of went the other direction, so this is a good time to invest. So why did that feel like a safe time to invest to you? And how did you choose to enter the space at first?
And so we chose to purchase a portfolio of consumer loans actually from a bank that partners with fintechs. And so that was really an eye-opening experience for me. We were able to learn from that bank and to see all the data analytics that are involved in that process, and a lot of banks, I think, looking back, were shocked at the performance of consumer loans during that period. And a lot of it was because of the stimulus efforts and things like that. But we were really not invested. A very small percentage of our portfolio was comprised of consumer loans, and so relatively speaking, in our entire loan portfolio, it still was a small portion of our overall picture. But we were able to do it in a small approach, and we were able to use the risk management to be able to accept that risk in order to grow our earnings. It was really a necessity. So, it was really through that purchase of that consumer loan where it opened our eyes to that experience and the scale that fintech partnerships can offer. So,
yeah, that's interesting. I'm also curious. You made some comments. We were talking earlier about the perception of risk on consumer lending and maybe what you think the realities of risk are. I'm curious, do you think there's an overestimation of the risk of consumer loans in general in the banking space? And why do you think that is?
Absolutely, especially when it comes to unsecured lending. I think a lot of bankers group unsecured lending in the same bucket. All of it is risky, and a lot of them want to stay away from it. But when we were first exploring, researching, getting into a little bit more into the unsecured lending space, I was analyzing a report that's put out by Experian called a payment hierarchy report. And so they really analyze and research how consumers prioritize different unsecured trade lines. So whether it be bank cards or retail and personal loans. And actually, personal loans were put at the top of the list when it comes to payment priority, is what Experian found. And so we just felt that over time, really, personal loans have really grown to be a bigger part of what banks are doing, and they're a little bit more accepting of that. And it's almost a necessity because a lot of times consumers also didn't look to personal loans, and I think more of them are finding use cases for them and ways that they can benefit from them in their personal life, whether it be to consolidate debt or anything like that. So,
yeah, we've certainly seen that from the consumer preference point of view. That a lot of the unsecured debt opportunities are, even secured debt in the form of HELOCs, are really line of credit oriented. And for a lot of the purchase stuff, people really, the average consumer is not that savvy about a line of credit, the cost, how to pay it down, what's my payment to be out of this thing in 2 years or 3 years, like what am I really signing up for? And I think they enjoy the certainty of an installment credit versus revolving credit, which is something that we haven't really focused on. We got credit cards and we got HELOCs. There are a lot of kind of lines of credit, but that installment, I think, for real borrowing is something consumers appreciate as a more clear way to understand the cost and term of their borrowing when they're really borrowing money for an extended period.
Absolutely.
So I'm curious, so you got into a fintech partnership. You are on the risk side, so I want to ask. This is an area where I think many institutions struggle with. How do I get comfortable with the operations that my partner has, with kind of the way those things are going? You guys were able to get over that hurdle for the initial purchase, and then we'll talk about kind of where you've moved from there. But how do you think about approaching that question? And do you have advice for other institutions that are looking at fintech partnerships? And how do I get, broadly speaking, the institution, the bank, on board with taking the risk going into that space where many banks fall down with just being able to get comfortable with stepping into that space and having a partner who's doing things on their behalf?
I think, first of all, I would like to point out that if you look at the data, your customers are probably leaving your bank and going to a lot of fintech lenders. So I read recently that over 51% of personal loans are now funded by or originated by fintechs. And so if we don't start doing these things in the banking industry, we're going to continue to lose customers. And so I would say, again, ultimately the greatest risk is that you're not able to meet the needs of your customers and you become stale. And so I would say, number one, that would be something to question internally. And then number two, I would say, try to engage your risk and compliance people and try to find fintech partners that are proactive when it comes to compliance. Like, for example, that's what was so appealing about Upstart, working with the CFPB and getting the no action letter and looking for products that really enhance your customers' lives. That's what it's all about, is trying to find customers and trying to find models that enhance your customers' lives. So that's, obviously affordable credit. And additionally, by engaging your risk department, you're able to use some of the frameworks that we utilize in other areas, such as vendor management, which is something that I have a strong background in, to manage that process of trying to, because when you approach a new fintech partnership or something like that, it can be overwhelming to think, where do I start? Where do I start reviewing documents? But if you take that same approach, there's certain areas that we want to review for a new vendor. Kind of take that same approach and then try to identify areas to kind of, to flesh out, to research, to make sure that your team is comfortable with all those different areas, or continue to ask questions. And so I would say vendor management is a great framework to use for that. But also, again, it's getting comfortable with the fact that we're going to have to learn how to do new things and manage new relationships and partnerships if we want to remain relevant. So, but at the end of the day, really, it's about trusting the people behind the company as well. You have to have transparency. You have to have a partnership model, or else it's not going to work. I think a lot of banks are really tired of being hamstrung by some of the larger banking providers, whether it be FIS, Jack Henry, and having to wait forever when you do project implementations and things like that. And so the more that we can work with companies where it's more of a partnership, where we can grow in a mutually beneficial way, that's going to be key. So but it is finding the right partners. It is finding the fintechs that are looking to improve people's lives. Ultimately, I think that's what it's about. And if they're not doing that, we shouldn't partner with them. So.
Yeah, I think that's a great point. I've said this to several of my guests, but having come from the technology space where there's so much focus on figuring out how to solve pain points for the user, it's not the public perception of banking, but when you actually get into the banking sector, people are generally in it trying to find the right products to help consumers meet their needs, and that's always a refreshing thing. And I think that joint North Star is a critical thing to have between the bank and any fintech partners. Like, are we really here for the same thing, which is to make find the needs of a consumer, to solve them in the best possible way, and to get that consumer access to the products and services that they need. And that's always been our motivating factor. I think you've kind of talked about this, but you kind of made a decision to shift a little bit from the original purchase of an asset. Doesn't really matter who they're from, but to actually being able to originate these products directly to your own consumers, or acquiring consumers, but not just an asset purchase, but more of an ongoing originating program. Talk a little bit about the decision to switch to that model, and was purchasing a loan portfolio helpful in getting the bank comfortable with moving to actually originating those kinds of assets directly?
So yeah, absolutely. We, like I mentioned, we originally purchased a portfolio. It was comprised of all unsecured loans, all basic unsecured personal loans, and that was really my first main project here at the bank, and so it was a lot to get over that hurdle and to get people comfortable with that. But then we saw how those loans performed. Like I mentioned, they outperformed every asset class, and so that got people more comfortable with that, and realizing that just because it's an unsecured loan doesn't mean that they're all going to get charged off. So it's really getting good at understanding the data and understanding that there are going to be losses in every type of loan category, ultimately, but it's getting comfortable with the data analytics and getting comfortable with how we're approaching the underwriting and things like that. And so that was huge. That was a pivotal moment for us. And then we really realized that we want to serve the customers in our community. That's what we're here to do. And so that's what led us to some of these fintech partnerships. And I think kind of spoke about this earlier, but a lot of banks just decide that they can't do consumer lending to any substantial degree. So they will refer people that come into their branches to other organizations, whether it be credit unions or so forth. So I don't want that to happen here. I want us to be able to offer our customers whatever they need when they come in the door, full service. And so that's been ultimately my mission, and what I try to do every day is how can we deliver our customers that walk in the door every single product that they would need to help improve their lives. And so I guess it's a mission of this bank, and it's also a personal mission of mine, because coming from that consumer background, I just see how offering some of those products can really enhance people's lives. And it kind of goes back to a lesson that I learned when I was in the branches as an assistant manager and trying to hit loan goals. It was something that, every month we had new account goals, new loan goals, and things like that. And it was a struggle for me to try to find ways to motivate staff and to get them aligned with that. And then I had a mentor that told me, instead of trying to hit numbers, let's just focus on saving every person that comes in that door as much money as we possibly can. And that was kind of a pivotal moment for me. It helped me realize kind of the why behind what we're doing. And if you can help people understand the why behind what we're trying to do, you can really accomplish a lot more when you kind of are all aligned on that general purpose and that general goal of what we're doing at the end of the day. So
and it's so much more motivating for the employee to feel that connection with it's interesting. We do this thing at Upstart where every Friday we get the whole company together, TGIF, a kind of Silicon Valley type thing. But we read a borrower review every week, who's somebody who's come on and said, thanks for this loan. Here's what I did with it. Here's how it's changed my life. And it's so motivating. I think it's easy to lose touch with how your products, particularly when you're a technology enabled a product, you can lose touch with how it connects to that consumer, what it's really doing for them, why it matters to that person that you're helping. But that is the true north, and it's the thing that's not only makes you more effective, but I think also motivates you. Most people they don't get in the business to play a numbers game, right? It's not a video game with Excel. It's it's something we got to do to actually help other human beings, and seeing that direct connection I think is so motivating.
Absolutely.
All right. So you were talking a little about, deciding to help the consumer get into originating. What's your path towards getting to that? And are you looking past, the unsecured debt you talked about to other kinds of consumer loans that have not traditionally been done at the bank? Like what do you see moving forward is where your focus lies in kind of the consumer lending space?
Ultimately, we want to be able to, like I said, to offer our customers the best in breed for every type of loan product. And so after personal loans, we're going to be looking to get more into the auto space as well. So we're going to be doing the auto loan refinances as well, and hopefully in the future focus more on direct auto. In my background, I found that people pay their car loans. They have to get to work. They have to get their kids to daycare, and so I feel like that's another area where bankers kind of they write those off as well because they think that auto loans are risky. But I think that's another misconception because people will pay that car before they a lot of times pay anything else because it's just so important in their daily lives. So I think that auto lending is another area for us to explore and to continue to grow and something that we're going to look to do next.
Certainly a critical consumer need, right? Like you got in this country, at least, you got to have a car to get to work, to get to school, to get to all the things you need. So it is something, and we certainly see it. You talk about the payment hierarchy or the waterfall. I think auto loans typically sit above unsecured loans in the payment hierarchy, and it's sometimes even above rent or mortgages because they're the thing you really need to get to work and pay the rest of the bills is the ability to actually access that. So it is I think a more safe form of lending than many people appreciate.
Absolutely. And another area that we're getting into as well is home improvement lending. That's another huge opportunity. And especially being in Florida, we have about 1,000 people a day that are moving to Florida. Just people who are purchasing new homes, they're doing renovations internally, and then the people that they sold their home to are also doing renovations and home improvement projects. You got more people working from home, so they're creating offices in their home, home improvement is a huge area of opportunity right now as well. So,
how are you tackling that? Are you doing that through like the more traditional HELOC approach that I know has been a bit of a decline? Are you seeing good demand? Like I'm just curious how you're tackling the home improvement space because it's you've seen unsecured lenders making offers there. We certainly see our lending partners have unsecured loans going to home improvement, but then you also see the home equity secured loans, second mortgages, HELOCs. How are you kind of trying to support the customers? Is there a particular focus in your approach in that space?
So twofold. So there's kind of two ways that we're accomplishing that. And like I mentioned, we are heavily focused in business lending and business relationships here. And so we recently partnered with a Fintech company that does point of sale home improvement financing. And so we're able to offer that financing option to our business customers that are in that space so that they can offer those loans to their customers. So that's been a really beneficial relationship for us to work with that Fintech company. And so then on the other side, when it comes to our customers coming in for home improvement projects, we're planning to offer those through Upstart. So we're kind of accomplishing that in two different ways. And so we're going to hit that full blast.
I like that. And it brings me to another question I wanted to ask you about, which is I certainly see as we think about digital transformations, some institutions who focus on kind of one platform to rule them all. I want to find one vendor that can do everything digital, kind of get me to the future with one throat to choke. And I'm not always convinced that's the best approach. I'm curious your thoughts. You clearly have at least two approaches in just this space, or two partners. You made a loan purchase as well as getting into fintech partnerships to originate. What do you think about one partner that's kind of trying to do everything, or specific partners that you think can deliver in certain areas? How do you approach that question?
A lot of times, I think banks they wait for some of the huge players, so FIS, Jack Henry, and things like that. They wait for them to come out with all of the product solutions, and by the time you wait on that, you wait to get on their project lists, and then you finally launch those products that are generally just a revamp of something that you're already offering. They may already be stale,
Yeah.
and so I think that banks are going to have to start finding more nimble companies such as an Upstart or another fintech partner that can kind of weave through APIs and things like that into those solutions, so that we can continue to innovate and to offer some of these new products and services that are continuing to excel and to develop. So I think that it's going to be extremely difficult for existing incumbents to just wait on some of the legacy providers, because by the time you launch that new online banking solution, it's going to become stale. So you gotta keep looking for new solutions and try to find the best in breed through multiple providers. I think I've actually heard that from some of your other guests on the podcast, that they've experienced some of those those same frustrations as well, where we can't just wait on them to come out with the next thing. We got to be proactive about it. So.
Yeah, you really got to push to move quickly. And then I think your point about integration, tightly weaving through APIs, I came from the enterprise software world into the lending space, and there's such a focus on modular interconnectivity now, because your CRM is connected to your email. You probably don't buy them from the same place. Maybe you do, you're a Microsoft customer, but many people are now seeing these intricate systems very tightly woven together. And I don't know that there's any good reason you can't do that with different experiences to present a nice unified front to your consumers, to your banking customers on the commercial side, but actually find the best solution for individual needs so you can move quickly. And that could be one provider doing two or three things, and it could be two or three providers. And I think it's a smart approach, but it's interesting to see how many people are waiting on whether it's a legacy provider or a single fintech to go, I'm going to do it all. And, waiting is, I think the key message I might be taking away from your conversation is waiting is riskier than you think. Doing nothing is riskier than you think, even though maybe that's the history of the industry.
Yeah, I recently read a report it was a fantastic report on embedded finance from Cornerstone Advisors, and they looked at where most banks were spending a lot of their resources doing new projects, and a lot of it was just what they consider a new project or a new service is just revamping an existing product, so online banking, rather than are we truly offering a new product or a new solution or a new source of revenue. So I think it's going to be important for banks to try to figure out how to weave in fintech into their existing product sets and to offer new solutions rather than just revamping existing solutions.
Just put a fresh coat of paint on the old thing. I did want to ask, since you're working with Upstart, one thing, maybe I should have done this earlier, but Upstart's platform is a bit unique for many of our partners, and the leveraging of AI for credit decisioning, the kind of sophisticated underwriting. I'm curious, two things for that from your point of view. One, was that component, the capabilities there, something that was, interesting and a real value driver from your point of view? And two, how did you get comfortable with the efficacy of a model that's not as clear as the traditional kind of here's 5 rules in a simple pricing table? How did you think about the value that brings, and then getting comfortable with, the way you can kind of oversee that element of how the partnership works?
To answer your question in short, yes, that was one of the main reasons that we decided to go with Upstart. And part of that was, I kind of alluded to earlier, the study that was done by the CFPB that found that the model enhanced credit access by over 27%. And so the reason behind our decision to move forward with that model was because of Upstart's proactive approach when it comes to the regulatory side of things, and our goal to enhance credit access in our communities. And so that was a huge benefit. We see AI as something that's not an evil thing. It's something that can help us to do more and to take out some of the biases that are just inherent in kind of a desktop lending environment. And so To answer your question, that was one of the major contributing factors to go for our decision to go with Upstart, was because of the ability to enhance credit access through that model, and also due to Upstart's proactive approach when it comes to dealing with regulators.
Well, I love your point too, that again, maybe this is kind of a theme for our conversation today, but there's always questions about potential bias in AI, but I have to remind people that there's also potential bias in the way we've always done things. Credit scores aren't equally distributed among different kinds of populations, and decisions that are manual are subject to bias too. So there's always, it's an important question, and it's why we, at Upstart decided to tackle it head on with the Bureau early. But it's also important to recognize that the risk of potential bias there has to be counterbalanced with the risk of bias in the way the system's always worked, which we know has not been optimal. So that's great. That's great to hear.
And also another thing that led us to have a little bit more confidence with the model is that we do have control of some of the overarching parameters with the system. And so the way I see it, really the AI is enhancing the ultimate decision, but we're still the ones that are making a lot of those higher level decisions when it comes to the credit access. And so I really see it as a way for
credit risk
to bring in more data, to think about more pieces when it comes to the entire puzzle of a consumer's credit history. And ultimately, we're still in control of the overall program to ensure that it's successful and it is enhancing credit access. It's doing the things that we want. So AI is not some consciousness in the sky that's making these draconian decisions. It's really a way to enhance our decision making process, and we have to manage it every day, just like anything else. But I don't think that it's something that's inherently evil. We're still in charge of making those overall decisions. So I think that's
inherently unmanageable. It is. Yeah. It is a manageable thing that you can tackle. Well, I appreciate you. Any closing thoughts? As you know, I've got 3 questions you've listened to a few episodes, I like to end the episode with, but any closing thoughts before I fire your 3 rapid fire questions for you?
I think we can just jump right into those rapid fire questions.
All right, let's do it.
Answers for those.
Yeah, I know. I'm glad you thought about them a bit of it. So my 3 closing questions that I always use. Number 1, Matt, what's the single best piece of advice you've ever gotten, career advice?
And we were talking about this a little bit earlier, but this is an unusual answer to this question. But the man who started this bank, Mr. Drummond, when I first started here, he actually gave me a poem, and the poem is called "The Calf Path." And I'm not going to read the whole poem, but just to kind of summarize, it's about a calf 300 years ago who's just kind of wandering around on his way home, and he walks through the woods and makes this crooked, gnarly path, no rhyme or reason. He's just trying to get home. Well, then the next day, a dog goes down that same path, all right? And then a sheep, and then the sheep brings an entire flock down that path. Then next thing you know, many men start following that same path. They're complaining the whole time that it's crooked and difficult to navigate, but they continue down that same path anyway. Well, ultimately, the road becomes a village, and then a thriving metropolis where an entire city is built on that path. And so at the end of the poem, the author says, "For men are prone to go it blind along the calf paths of the mind and work away from sun to sun to do what other men have done." So essentially, I think it's extremely relevant to the banking industry, because a lot of times we just get stuck doing the same things just because that's the way we've always done it. So someone just decided along the way, this is the way we should do this procedure, that procedure. And then when we ever question that, it's, well, this is the way we've always done it, so we're going to continue to do it that way. So when you're looking at new things, whether it be fintech partnerships or anything like that, just think about this poem and just think, is there a better way that we could be doing this to serve our customers? So I think that was the best lesson of my career, and something that I try to think about every day. So
I love career advice through poetry. That is a first on the podcast, but I appreciate it. I think it's great. Well, for those who are interested, we will get the link or the text of the poem in the show notes, so you can see the whole calf path poem for yourself. So, Matt, second question for you: what's the single best advice you've gotten about the consumer lending space?
It's actually something I touched on a little earlier in the podcast. Was instead of focusing on hitting individual loan goals and looking at numbers, If you're trying to motivate staff or to try to get people aligned on a goal, just focus on what you're doing for that customer. So when it comes to auto refis and personal loans, let's focus on saving them as much money as we possibly can and improving their lives. And everything else will take care of itself, because that's what we're here to do. We're here to help people.
All right. I like that. And the third, focus on your customer. Third, what is one bold prediction you have for the future? Hardest question.
I truly believe that embedded finance is going to be a huge share of the puzzle and the entire pie when it comes to consumer lending. Really there's two main areas when it comes to embedded finance. And if you were to put a room filled with 100 bankers, probably only 5 of them, maybe 10, are going to know what embedded finance even is. But it's going on right now. And so really there's two main areas. And you have embedded finance and embedded fintech. And so embedded finance is the integration of banking services into non-banking websites, applications, things like that. So a great example would be Walgreens is now offering a checking account. Google is offering the Plex account. You have Amazon offering financial services. You have the buy now, pay later fintechs that are weaving in the financing into those marketplaces. And so that's an area where banks can compete in. It's going to be more difficult, but I believe embedded fintech is going to be the main area where banks can really compete, and that is embedding fintech offerings into your existing product sets. So some great areas for that are going to be things like subscription management, bill negotiation services, credit monitoring, things we're hoping to offer here in the future. And so I think that banks are really going to start to, they really need to begin thinking about some of that instead of how can we revamp existing procedures. So I think I would urge a lot of bankers listening to this podcast to really explore embedded finance and make sure that you are making those strategic partnerships to set yourself up for success in the future as consumer preferences continue to change.
I like embedded finance. Well, Matt, thanks so much for joining us. I really enjoyed the conversation. I mean, I think my main takeaway was probably the recurring theme of the risk of staying still or the status quo versus the risk of change, and not underestimating the risk of the status quo. But you also broke new ground here with career advice via poetry. I think a reminder to always focus on the providing value to your customer and your consumer is kind of the true North Star. And don't forget about figuring out how to play in embedded finance and how that's going to change the world. I think those are great tips. So thanks so much for joining us today.
Absolutely. It was a fantastic conversation, and hopefully I can be back on in the future maybe.
I'm sure we'll find a time to bring you back. Thanks.
Awesome.